Okay, hello Finimizers, and welcome to another Finimize Live. My name is Max. I'm the VP of Community here at Finimize. I'm very happy to host today's event, Unlocking the Power of ISAs in 2025 with our partner Saxo. If you don't know, they are a platform that allows you to invest in everything at a low cost, all in one place. So from stocks, ETF, funds, or bonds. This event is all about making the most of our UK tax-free allowance. So think about your stocks and shares ISA. In Saxo, you can invest in more than 11,000 stocks, ETFs, bonds, all at an industry-leading price, but specifically in their market-leading stocks and shares ISA. If you do want to find out more about Saxo, then just hit the link you'll see in the chat box. It wouldn't be a finance event if I didn't start this off with a disclaimer. Your capital is at risk. This is not financial advice, and your tax treatments depend on your own circumstances that may be subject to change. With that out of the way, I'm very excited to have Dan Squires, the Chief Commercial Officer at Saxo Markets UK. And he joined Saxo in May 2023. But before then, before he took on the Chief Commercial Officer seat, he spent 30 years in equities. Bank of America, Citi, RBC, and Liquidnet are on his CV. So we're very privileged to have Dan here today. And Dan, look, it's great to have you here. How are you doing today?
Right. Yeah, great. Thanks, Max. Really good. Looking forward to this. As you know, I did a panel thing at the Finimize Investor Summit last year. Very much enjoyed that, which was obviously an in-person thing. And here we are again today. I think the Finimize community is fantastic. So happy to be here.
Wonderful. Wonderful. Well, I'm going to get stuck right in. We don't have long. We have about 15 minutes for our conversation. Then we'll move over to Q&A. Dan, look, here in the UK, ISA season is approaching. Can you just talk us through the different types of ISAs available to investors right now? Now, I know it seems basic, but it gets very complicated with the amount of options that are presented in front of you. So talk us about how they differ in terms of benefits and also eligibility.
Yeah. So look, ISA stands for Individual Savings Account. Doesn't really tell us anything. I think what's important to establish from the get-go is that these are what people call tax wrappers. They are effectively government-subsidized schemes or products designed to encourage people to invest. So broadly speaking, I would say there are 5 types of ISA, and some of those we don't really need to talk about today, but they are cash ISAs, the clue's in the name, it's literally just cash. What's called stocks and shares ISAs, very much more like a standard investing account. There's something called the Innovative Finance ISA, which I don't really suggest we talk about today, but that's to do with things like peer-to-peer loans or crowdfunding. Then you've got the Lifetime ISA. That is basically, there's some certain eligibility rules around that. That's designed to encourage people to save a deposit for their first property purchase. And then there's the Junior ISA, which is for under 18s.
So you can already see how complicated that can be.
Yeah.
It's supposed to be a simple savings product.
I know. So what I would say is that, look, like if you've got kids and you want to encourage them to invest, the Junior ISA is a great thing. Lifetime ISA has a whole load of rules around it. But all people should really know is that you can put 4K in and the government gives you an additional £1,000. If you fit the eligibility rules, £1,000 free is £1,000 free, right? That is, some people say a bit of a no-brainer because it's free money. But I think probably what we want to talk about today largely is stocks and shares ISA, but also just let's touch on cash ISAs because it's a bit of a weird thing in the UK that the cash ISA is super popular. I personally have no idea why, but I'm happy to talk about it.
Well, let's tackle that now, right? So when, in your opinion, does it make sense for one of us to use a cash ISA versus a stocks and shares ISA, if at all?
So a cash ISA is, people kind of like them because I think they feel that it's safe, right? You can't lose money, obviously. It's literally like a bank account where you just put up to £20,000 cash. Not particularly exciting. And I think that a lot of people tend to forget the difference between nominal and real returns. if you're living in a time of inflation of, let's say, 3% and you're making 4% on your cash ISA, it's not really that interesting. And often the rates of interest on these cash ISAs are less than what you might find in a really good savings account. So, if you just want a super safe home for cash and you're not very interested or motivated by the return, nothing wrong with a cash ISA. But hard to understand really the attraction of it, given that the whole idea of an ISA is about encouraging long-term saving. It's about harnessing the power of compounding. And to me, what you really want to be thinking about that is, higher return investments. And this is really where the stocks and shares ISA comes into it. By definition, a cash ISA is not ever going to compound by very much. And secondly, I would say maybe there was a case for these things, a year, 2 years ago, but we're in an environment now where interest rates are being cut. So, the return you're going to get on that cash ISA by definition is minimal and is highly likely to be falling. A lot of people are forecasting 3 or 4 rate cuts from the Bank of England this year. So cash ISA is just really very similar to a bank account in that sense. It's your cash. You can't lose money, but you're not going to make very much.
Because I can totally see, I've fallen foul of this trap, and I know many Finamisers do as well. It's this question of, look, we know that long-term investing is the right thing to do. Put money in an investment account and leave it in there for as long as you can. But we're always I'm always hampered by, okay, but I don't know what I'm going to do next year. I want to have some cash in my account, and I want that cash to allow me to do things like go on holiday. Potentially, I'm going to buy a house. Again, all of these things getting in the way of me opting for an investment ISA. Just let's clarify on this. We spoke about the cash ISA. Talk to me about give me the best case for using a stocks and shares ISA to put your investments in.
So the best case really is quite simple. What we're talking about here, the reason ISAs are fundamentally attractive is you are avoiding paying capital gains tax. Now, so 2 things to know on this. Number one, in the UK, the amount of capital gains you're allowed to make each year that are free of tax, that so-called tax-free allowance has gone right down. I think a year or 2 years ago, it was 12 grand. It's now 3, right? So if you made a capital gain above £3,000, you're going to be paying capital gains tax. So then the second question is, well, how much, right? The tax rates themselves have also gone up recently. And depending on your own personal circumstances and essentially how much you earn, that tax is between 18 and 24%. So the best case scenario is really simple. You've invested in the S&P 500, let's say, a low-cost tracker, an ETF, right? Since 1957, the S&P's compounded at just over 10%. You want to be doing that and not paying, ultimately, 24% or more, tax rates could go up on your profits or so-called capital gains. So if you wanted to construct the best case scenario, you could go, well, I'm going to invest 20,000, which is the current limit, every tax year. It's going to compound at 10%, and I'm not going to pay any tax on it. People may know something called the rule of 72. If you want to understand how quickly something's going to double, you take the rule of 72, you divide it by the return. So if you think you might make 10% a year, which is what the S&P's done, but I mean, you might do it in other ways, picking your own stocks, you're going to double your money in 7 years. So not paying away nearly a quarter of your profits, if you're earning more than 50,000 a year, is massive. Make a massive, massive difference to how much this pot of money is going to grow to. So look, 20,000 a year is the annual allowance. It doesn't necessarily sound a lot, but the whole point here is, I think, to think long term, to think about compounding, and to start early. And if you can only start with £1,000, that's fine. It's just, why would you pay away nearly a quarter of your profits when you don't need to? So that, to me, that's the argument in a nutshell. It is maximizing your ability to grow your wealth.
So, as I understand correctly, if anything I have going into an investment portfolio that isn't in an ISA, I should put it in a stocks and shares ISA up into £20,000 in that year, and then just do the same thing again next year.
Yeah, pretty much. I mean, SIPs, personal pensions, are obviously, they are tax wrappers as well, but that's a whole different probably webinar on that, because if you tuck money away in a pension, you can't access it until you get to retirement age. The thing about an ISA is you could find you need the money for some unexpected reason. Maybe you want to go on holiday, perhaps you're getting married, whatever it is, life event, you can take the money back out. And just to add to that, there's been a recent development, something called the flexible ISA. And this really is a genius product because it allows you to put money in, take money out. And this is all about tax years. So the avoidance of doubt in the UK, that is the 5th of April. So we're in obviously beginning of February now. You could put 20,000 in now or whatever much and go again on the 6th of April. The thing about a flexible ISA is you can put money in, take money out without losing your allowance. So let's imagine you invest the money. You choose some great stocks, or markets go up, or maybe you were long Palantir into its earnings and you've made 20% today. You might then decide, oh, well, I'm just going to take some of that cash out. I'm going to pay for a holiday, whatever else. Then maybe you get a bonus from work later in the year. You put money back in. So it's this ability to use the cash as you see fit for your own life, have it invested when you don't need it, take it out when you do. With a normal traditional ISA, once you take that money out, that's it. You can't put it back in. So flexible ISAs are really, I would say, quite a very customer-friendly product, and something worth taking advantage of.
Yeah, totally. And, I think, as we know, one of the biggest problems that I find with the whole investing thing is just some of those behavioral biases that kind of stop you taking any kind of action. So I agree with you. Love the flexible ISA. What I'd love to do, whilst we have someone with 30 years of experience in equities on this session with the community, is talk a bit about what we should put in that ISA. So talk to me about trends, sectors that you are interesting right now to help us grow whatever we put in that.
So I think that's it, Max. I think that's the thing is, remember, the ISA is just a wrapper. There's no special sauce really in an ISA, but obviously what you want to pay attention to is fees, charges, the range of stuff you can invest in. By the way, the government, HMRC, Inland Revenue, has a list of ISA eligible instruments. So, and your provider, broker, platform, Saxo, whoever, will know what that list is, right? That's our job, to only let you buy eligible instruments in an ISA. But so not something to worry about, but just something to be aware of. So tax-free wrapper, we've established why that's interesting. It allows you to compound and to the max. So the obvious thing is ETFs, right? We love ETFs. Why? Because they're a great way of investing in themes at super low prices. So what could be interesting around that? I think there's no point in me talking about tech stocks and Mag 7, but one theme I do like, which I think is going to run and run. We're trying to talk about long-term investing. So let's think about long-term power themes. What could they be? Defense, to me, is one. Trump as a catalyst. Trump badgering NATO countries to spend 2.5% of GDP. This is a real issue in the UK. Are we going to meet our promises to NATO or not? So you might look at that and go, well, it feels like we're living, unfortunately, through a time of more conflict. We've got President Trump basically threatening to rip up NATO unless other countries spend the money. There's a variety of ETFs that you can play that theme. There's even one with the ticker NATO, which makes it really easy to remember. I personally quite like that because it does what it says on the tin. Then you might have another theme. Could be something like, just for fun, personal vanity, obesity. You might say, look, I know loads of people now on Ozempic, right? This is not just a thing for last year, and this could be a thing for the next 10, 20 years, right? We might have solved for obesity and another interrelated thing. Novo Nordisk, without checking, I'm pretty sure the shares are down 30, 40% off their highs. They had some slightly disappointing data. So power themes is one way to look at it. AI would just be a sort of obvious example. So if people don't know where to start with specific stocks, I would say start with themes. Right? Then it might be another good thing I always think is to just deploy your own real life. Right? I walk through Stratford Station every time I commute in from Kent, and the biggest queues I constantly see are outside Greggs. Now that's not a new observation, but that might make me think: is Greggs? Could that be a good investment? Is it cheap? Is it expensive? You can take your own real life experience and apply it to investing. Big themes that I guess that we've seen at Saxo is, to be honest, our clients have been buying the dip, so to speak, on the recent tech volatility, on the AI sell-off. I don't think there's any change to that. Yeah, you can go anywhere with themes. You could kind of look. You could go anti-Trump, and you could say, I still personally think net zero is a massive thing in my lifetime. I think that green energy is a massive power theme. I'm going to put that in my ISA, and you might find some ETFs that play it. You would certainly find some investment trusts trading on big discounts to NAV. You could buy wind power, wind turbines, for 70p in the pound.
And I love that you're talking about this, Dan, because I think so often, especially on the topic of ISAs, platforms often will lean to, what is the safe, conservative, and long-held views. But actually, ISAs are just a wrapper for you to put your investment portfolio in. So I love that you're talking about trends. Yeah. Love that we're engaging our audience in thinking for themselves.
I mean, it's for people to think for themselves about how much risk they want to take, where their knowledge is, how much they want to choose their own investments. Most people's answer to this, it seems to me, is always just buy the S&P 500. And that's because, as the name suggests, it's 500 stocks, albeit it is a market cap weighted index. So what that means is you are actually quite concentrated. You're placing a lot of bets on the biggest companies in America. But, the long-term track record, I quoted it earlier, is unbelievably good. I think if I, with my own money in my ISA or my pension, could make 10% every year, I'd be extremely happy. And that's what the S&P 500 has done. So that is kind of like the default answer. But you could do that with 70%, and then you could do some other stuff with the other 30. There's a lot of different ways, depending on people's risk appetite and aspirations for the return they want to make.
Totally. And we're going to jump into the Q&A now. And I just, my final thought on that is that it's never been easier to invest in an ISA, right? With platforms like yours and other platforms on the market.
I mean, literally, probably, let's say you already had an account somewhere. I mean, it would be 2 minutes work to add an ISA.
Yeah.
Just one more thing while I think of it, Max.
Go for it.
I don't want to assume everyone's into risk taking and looking for capital gains. It's also worth stating you don't pay tax on dividends in an ISA. You could put 20 grand into some safe as houses, high yielding. Let's take UK stocks. BP, without checking, probably pays 6% dividend yield. Legal and General, whatever it is. You could be an income investor. You don't pay any tax on dividends in an ISA.
Totally. Very, very good and overlooked point. Right, I'm going to jump over to the community. So everyone here that's listening now, I love seeing how many questions have already come in. Please pile in if you do have questions. More importantly, please upvote the ones in the list in front of me, and I will be asking them directly to Dan. We've got 7 minutes. I'm going to see how many we can get through. So Dan appreciates sort of short, sharp answers to these simple questions. Right, off the top, Stephen, thank you very much for this. Is there a rule for selling growth stocks in my ISA portfolio, like Berkshire Hathaway at a 50% profit, Palantir, 84% profit, Tesla? Stephen, if this isn't a humble brag, I don't know what is. Tesla at 165% profit, to reinvest into dividend stocks, or do you just hang on to that growth stock?
Right, short answer, there is no rule. Long-term things do move in cycles. The gap between value and growth has probably never been wider. Many of the stocks just mentioned are expensive by classical valuation observations. I wouldn't be averse to maybe just take it, but it's down to individual. There's no rule really, and I think we might be living through, a new kind of industrial revolution. AI and tech stocks could just keep going.
Love it. Thank you. On to the next one, Richard. The stock markets are at an all-time high. I mean, we've been saying this for nearly 10 years now.
Yeah.
Surely the markets will turn. But when that happens, you will lose your capital gain unless you're smart enough to have chosen a stock that is fairly injured to stock market, fairly inured?
Yeah.
Defended against stock market crashes, I think is what Richard's trying to say. Remember,
Yeah.
the Black Swan event can happen at any time. What advice do you have to mitigate risks?
Yeah, it's a good question. I mean, look, the simple answer is diversification. Don't have all your eggs in one basket. And that doesn't just mean don't invest in one stock. Think about the themes you're exposed to, the type of valuations you're exposed to. If you're all in on expensive growth and there's a market sell off, obviously it's going to hurt. But if you had 30% of your ISA in what I said, high yielding dividend stock,
As Dan joins, by the way, guys, the questions you're asking, every single person in our community asks us this constantly.
apologies again to the.
That's okay, Dan. You carry on.
Yeah, so you've got to think about this geographic diversity, right? Style diversity, growth versus value. You might want to think about currencies. I mean, it's a stupid point, but imagine you were massively exposed to Mexico and the Mexico peso suddenly moves on tariffs. So I hear the question, and I think the answer is to be diversified in as many ways as possible. And look, for me personally, I would always have a chunk of value stocks because I kind of like the income, and I know they have what's called valuation support. So if we had a horrible market crash, something that's yielding already 6% and can definitely pay that dividend, it's not going down very much. It's a bond in disguise.
So diversify, guys. There's some lovely practical questions that I think we can fire through. First, so is 20K the upper limit in any given year, or can you add to it every single year? I think just clearly explain what we mean there by the 20K being the limit.
So the year in question is the tax year, not the calendar year. You are allowed to put £20,000 maximum in every tax year. You can't take an unused ISA allowance and move it forward like you can do with some tax stuff. It's literally 20 grand a year, use it or lose it.
Wonderful. Second practical question, and which is why now is a key period to think about that, because that clocks in April. Second question, I love this. Let's just say I have £5,000 to put in an ISA. Which one do I go for? Bear in mind, I'm new to investing and I don't want to make the wrong move.
Well, I think for reasons already explained, it's stocks and shares ISA. I think it's a small number of very low cost ETF index trackers. S&P 500, maybe MSCI World. I have one in my own portfolio, which is it's called something like Dividend Winners. There's so many things, but a small number of low risk index trackers and start from there.
I love it. This one has to be one of my favorite questions of all time. How do I convince my husband to start investing? I'm the only one investing in a stocks and shares ISA, and he won't listen to me.
Right. Look, I'm guilty of this, by the way. What far too many people do is they spend their money on depreciating assets. Right. Now, I don't know about this husband. Maybe he wants a Porsche. Wouldn't be unusual. Now, that Porsche is only going to depreciate, and it's going to cost you on the monthlies. The whole point is here, you use your cash flow, your spare cash, to invest in appreciating assets and then buy the Porsche in 10 years' time. There's only really two ways you're going to make money. One is if you're lucky enough to own property on a small island with constrained supply, and the other is through investing. So I don't know, but I just understand the power of compounding. Literally, any amount is good enough. The earlier you start, the better. Avoid paying tax. You don't have to. You start playing around with the maths. It is unbelievable. Rule of 72. Just remember that. Google it. And don't trust me. Go and Google a video from Bill Ackman, billionaire US hedge fund manager, who explains this. It's just fantastic. Show him the video.
Wonderful, wonderful. We look forward, like this may not be financial advice, but I love that we're giving relationship advice in this community. There's no better sign that we've got a powerful community that we're willing to talk about these kind of topics. It's also, the beauty of this is just showing how easy it is to get started. I think we've got time for one more question. It's a very practical Saxo related question. What are the fees like in Saxo? Jackie asks, in comparison to Vanguard's well-covered recent rise in fees, and especially on ISAs and these SIPs?
Right. I'll try and answer it quickly and simply. You've got a few different types of fees, regardless of who you're investing with. One would be the product fee, right? So we talked a lot about ETFs. No ETF is free. You'll have something called an ongoing charge. Vanguard's put theirs up. So that fee is charged by whoever's running that ETF or that fund or whatever it is. The thing I would highlight, and obviously I work for Saxo, is, but I just think there's a complete lack of understanding on this. People need to think about so-called FX conversion fees, currency conversion fees. We live in a time where UK investors, largely speaking, invest in US equities, right? The fee you will be charged for converting your pounds to dollars, even in an ISA, when you buy those US stocks, is far bigger than the execution commission. So don't be misled by free trading. You need to look at all the fees overall. But there's no reason, I mean, a fee on a popular ETF might be 10 basis points. We might charge you 5 basis points to execute that. Saxo's FX conversion fee is 25 basis points. So you are all in for considerably less than 0.5%. And if you owned it for the next year, never traded it, and the S&P went up 28% like it did last year, well, obviously, the fee's pretty low relative to the return. Different platforms charge in different ways. Just don't be misled by this idea that you can do it all for free. You can't. There's that famous adage, if you're not paying for the product, you are the product.
I love that. And I love platforms being transparent about fees. So thank you very much for that, Dan. Look, guys, we're out of time with Dan, very sadly. However, you can join us alongside the team at Saxo, another event coming up on April the 8th, as we share how you can level up your ISA strategy this year, talking about those flexible ISAs that Dan is a fan of. So grab your free ticket using the link in the chat. Check out Saxo's platform using the link in the chat. And as you leave, please do me one favor. There's a survey on your screen. It's the only way that we improve these events. Please take a few minutes to let us know what you will be interested hearing about in the future. Thank you so much, community. I love you guys, and I look forward to seeing you at the next event. And thank you, Dan.
Thank you.